My name is Clarin Infante, and I am presenting on the HealthSouth accounting scandal. HealthSouth is a public healthcare company that operates in the United States and Puerto Rico. It provides rehabilitation hospitals for patients with physical disabilities due to medical conditions. HealthSouth was established by Richard Scrutchy and a few close associates in 1984. Richard Scrutchy, who was a therapist and a businessman, was the chairman and CEO of HealthSouth. HealthSouth grew tremendously during the 1990s, and by 1996, when Scrutchy took his company public, HealthSouth had a massive market value of over $12 billion. However, HealthSouth's growth, market value, and financial statement values were not nearly what they appeared to be, as HealthSouth executives had perpetrated an upwards of $2.7 billion of accounting fraud. Problems at HealthSouth started to become evident in mid 2002. In May, Mr. Scrutchy sold more than $75 million worth of HealthSouth stock, and in June, he sold another $25 million back to the company. HealthSouth then disclosed in August that a change in medical payment policy will significantly lower reimbursement, causing the company's stock to lose more than half of its value and leading to shareholder lawsuits alleging that Scrutchy had acted on insider information when selling his shares. Then, in February of 2003, the Federal Bureau of Investigation announced the opening of a criminal investigation of HealthSouth for possible securities law violations. In 2003, HealthSouth was found guilty for making investors believe that the target earnings were met. Accounting irregularities were found between the periods of 1996 and 2002. Financial reports were manipulated to meet or exceed Wall Street earnings expectations. According to the complaint, before HealthSouth's earnings were released each quarter, management will brief Scrutchy on the actual figures. If the figures were less than Wall Street analyst estimates, Scrutchy would instruct the company's senior corporate accountants to fix it in order to meet the street's expectations. These accountants, known as a family, would then hold family meetings to determine how they could inflate the company's quarterly earnings and make the necessary adjustments. They use techniques including improperly capitalizing expenses, overestimating insurance reimbursements, over-evaluating fixed assets, using faulty reserve accounting. Once the accounting scandal went public, HealthSouth's share price tanked to 35 cents per share, costing their shareholders millions. Despite seemingly being the obvious mastermind behind HealthSouth's accounting fraud, Scrutchy denied and still denies to this day that he was involved in any way. Scrutchy claimed that the other executives took part in the fraud and kept it hidden from him completely. Despite his expressed innocence, Scrutchy was convinced for accounting fraud and served a 5-year sentence. In addition, he paid $81 million to the SEC to settle civil charges related to the fraud. HealthSouth fired its independent auditors, Ernst & Young. Ernst & Young also settled the shareholders' class action lawsuit for $109 million, reaffirming their negligence in their audit of HealthSouth. Since the company's accounting scandal was first discovered in March 2003, HealthSouth has taken many steps to turn itself around and become a stronger company. They fired former CEO and CFO, and it has a new senior management team, and the new directors who presided over the company when the fraud occurred have since been replaced. HealthSouth was also able to avoid bankruptcy by selling assets and reaching various agreements with lenders to refinance its debt. Hundreds of consultants were brought in to help reconstruct the company's records, develop improved accounting and reporting policies, and establish a stronger Sarbanes-Oxley complaint system of internal controls. The lesson of HealthSouth offers a powerful reminder that when it comes to financial reporting, things that are things are not always as they seem. Whether the fraud should have been uncovered sooner is an open question. Analysts and investors should always be careful not to review companies' financial statements with an uncritical eye, nor should they take management assertions about company health and various forward looking projections at face value. There are simply too many incentives and pressures on public companies to report favorable results and give them a positive spin, and sometimes people cross the line as a result. But can fraud of this magnitude, scope, and duration still occur now that we are in the area of Sarbanes Oxley? Will anybody even try? Only time will tell.